Hi, I'm Kyle Ashcraft of Maxwell CPA Review, and this is the first video in a series of videos to teach about important topics for the BEC exam. So we're going to talk about product cost in this video. We're going to cover the three types of product costs, and we're going to go through an example to explain them. So I hope that you get something out of this video, and with that, let's dive in.
So, what is a product cost? It is a cost that is associated with creating a product. There are three types of product costs: direct materials, direct labor, and manufacturing overhead. Direct materials are the actual physical materials going into the product. For a laptop manufacturer, the aluminum and glass going into building the laptops are the direct materials. Direct labor is the wages you pay to your employees to make the product, like when you pay a factory worker to put together the laptops. The third product cost is manufacturing overhead. Overhead includes items like the cost of rent and the utility expense to keep the electricity on. It's hard to break down these costs to a per unit amount, meaning it would be hard to say that it costs 35 cents worth of electricity to produce 1 unit. So here's the key behind product costs. Product costs are not expensed until they are sold. Before they are sold, they remain in inventory accounts. There are 3 different inventory accounts that they can be put in: raw materials, work in process, and finished goods. Raw materials is the inventory account for the physical materials that you have purchased yet not started using yet. The work in process inventory account is for all of the products that you have started but not yet finished. So when you start using raw materials for production, they move into the work in process account. The direct labor costs and the overhead costs that you spend get recorded directly to the work in process account. Once you do finish the products, then you move the balance out of work in process and into finished goods. The finished goods inventory account is for all the products that are completed but not yet sold. And then once a product is sold, it goes to an expense account called cost of goods sold. The moment it is sold, all your product costs change from being a balance sheet item in the finished goods inventory account to being an income statement item in the cost of goods sold expense account. You might ask, why do we wait until now to record the costs as an expense? It is because of something called the matching principle. The matching principle says that we don't recognize expenses until we recognize the revenue associated with those expenses. If we expensed the product cost before selling the products, then our income statement would be skewed. It would show all expenses and no revenue. And then once we sold the products, the income statement would show only revenue and no expenses. So the matching principle is why we have to wait until we sell the products to expense them. Before they are sold, the costs remain in the inventory accounts.
So there you have it. We've talked about the 3 product costs, we've talked about the 3 inventory accounts, and then we've talked about, because of the matching principle, why we have to wait until we sell the items until we expense them. So thanks so much for watching, and keep an eye out for the second video in this series.